What's the difference between prop trading and what happens in the sales and trading that we talk about at an investment bank? So first of all, for those of you who are not used to the abbreviation, prop trading stands for proprietary trading, meaning trading your own money. Now, this used to be something that was ubiquitous across the street at banks. You would have the Lehman Brothers prop desk, the Morgan Stanley prop desk, the Credit Suisse prop desk, and all these banks would be trading money that's backed by the deposits at that institution if it took deposits at the time. Back in the early heyday of like the 2000s, when Kristen and I started in the business, this was the big sexy thing, right? You were basically running a little mini hedge fund at a bank. So it's great because you had all the stability of the big institution around you. And that was a buffer with which you could then take risk and hopefully make outsized returns. Unfortunately, there were some very big outsized losses, which if you have not listened to our episode about the fall of Lehman Brothers and the financial crisis of 2008, that's worth a listen. I think the Morgan Stanley prop desk, when you were there, Kristen, you told this story during that episode, had like a $9 billion intraday loss on some of their MBS positions. And I called you being like, are you okay?
Yes, you did.
Yeah. You told that story. And I was like, are you
like,
all right?
I'm okay over here at Lehman.
So after the financial crisis of 2008, with the Dodd-Frank regulations being put into place to kind of limit banks' ability to take risk, something called the Volcker rule was passed. And the Volcker, God, that's a hard one for me to say. And the Volcker rule was designed to minimize proprietary trading at banks. It basically regulated it out of existence. Now, there are some exceptions within the rule, and that rule is actually still kind of constantly debated. So it's a very fuzzy thing. And I'll get to that in a second. But it's the kind of thing also that could always be rolled back. Now, I think in the current kind of political environment, no one's really like, you know what banks should be doing? Taking more
prop trading. Yeah,
let's risk up those banks a little bit more. I don't think anyone's feeling that way in the summer of 2023. I could be wrong. But it basically made it so that if you want to take proprietary risk, meaning trading the firm's own money, you need to go outside a bank. You need to go to a buy-side firm, an asset manager, a hedge fund where you're trading someone else's money, or you go to what is called a prop shop. And that is where you are trading your own money. This is different from, say, a hedge fund, something we've talked about a lot as a way to make outsized returns. Because again, with a hedge fund, sure, you're probably going to have some very senior partners at the hedge fund who have their own money invested in that hedge fund. But by and large, that giant pool of capital is other people's monies, is institutional investors' monies, the money of pension funds, things like that. So they pay themselves out. Typically, again, we've talked about that 2 and 20 fee structure, meaning a 2% fee on top of all the money that's put in, and then 20% of the profits are paid back to the people within the fund. And we've talked about fee compression. We've talked about how that fee structure is not necessarily uniform throughout the hedge fund world, but generally speaking, you are limited in terms of how much of that profit you pay back to yourself within the hedge fund. The rest of those profits goes to the investors who've given you that money. So what's very different about a prop shop from what happens at an investment bank in the sales and trading division is that the sales and trading division of an investment bank is not in the business of expressing views. The traders there are in the business of making markets. They are in the business of facilitating client trades. So the prop shop is the client, and the investment bank, the traders at the investment bank in the sales and trading division, are the market makers. So if the prop shop comes in and wants to buy 100 million 10-year notes, it is the trader's job at the bank in sales and trading to make them a market, to be the seller for that buyer and vice versa. Now, there is risk inherent in taking any position. So there's going to be a charge embedded in that trade in the form of a bid-offer spread. And the trader is trying to capture that bid-offer spread at the investment bank to compensate them for the risk of taking on that position. Now, in a oversimplified world, they will then go and hedge out every single position and just capture that bid offer spread and pick up pennies in front of a steamroller, right? But there is discretion allowed within these investment banking trading books so that the trading desk can make more money than just that bid offer spread, right? And guess what? You're not going to make the bid offer spread on every single trade. Some trades you'll lose money on. But let's say that the prop shop comes in and wants to buy 100 million 10-year notes. If I, as the trader, the market maker at the bank in the sales and trading division, have the view that prices are going to go down, I might not cover that short immediately. I might let it ride. I might let it ride for a day. I might let it ride for a week. It all depends on my view. And I can apply my own discretionary view on the market to that position and make excess returns on having facilitated that trade by not hedging it out immediately. There are tight risk limits that I will be held to. So if that position starts going against me and I've lost $10,000, no one's probably going to blink an eye. If I lose $100,000, someone's going to say, hey, what's going on? If I lose $1 million on that position, someone's going to tap me on the shoulder and say, hey, like, how strong is your conviction in this trade? What are we doing here? And if I lose $10 million on that trade, I'm probably not going to have a job tomorrow. So there are risk limits within which those traders on the sell side can operate. They don't just have free reign.
Yeah. I say, to your point, when you're talking about going out and covering the short, if you have something very liquid, so like a 10-year note, well, yeah, you can easily go find that. So if you've sold these 10 years, you can go buy it on the other side. It gets a little trickier as you start to get different types of more illiquid securities. You should go back and listen to the What is Sales and Trading episode. I think that's what we named it these days. But Jen gets into such a great explanation on market making.
Yeah, no, and I think market making is not fully understood by everyone, because when we say we don't allow proprietary trading at the banks, okay, well, aren't they taking a proprietary position then if they express that view by not covering their short? But the bank is also in the business of making money. So there's this fine line that they are walking every single day between allowing traders to take some discretionary views in the process of making markets. Because guess what? If you lose money on every single client trade, you can't make markets for too long, right?
Right.
And because some of these desks are facilitating hundreds, if not thousands of client trades a week, they build up a very large book of positions that aren't all just neat little buy, sell, 10-year notes. These are complex positions across the yield curve, across asset classes, across different, for example, expiries of options. So they end up building a complex portfolio that then has its own inherent risk because everything isn't just perfectly hedged out. And then they have to trade that ongoing inherent risk of the portfolio from day to day to either A, keep from losing money, and or B, generate additional revenue for the firm. So it's all part and parcel of the job. Unlike at a prop shop, however, if you are a great trader and you make hundreds of millions of dollars trading that portfolio of books and facilitating those client flows, you are going to get paid out a relatively small percentage of that profit because it's not your money that you're trading around. Whereas if you're at a prop shop, you can keep as much of that as you want. You make the rules because it's your own money.